6 months might not sound like enough time to completely transform your financial reputation, but here's the reality most people miss. Your credit score isn't a fixed identity. It's a system reacting to your behavior in real time. If you're sitting at a 650, you're not bad with money. You're just sending the wrong signals to the scoring model. And in 2026, with how fast data updates across the major bureaus, those signals can be corrected far quicker than most people think. I've seen people jump 100 to 150 points in under half a year, not because of luck, but because they understood exactly how the system, especially FICO, actually works and then played the game strategically. At its core, your credit score is built on a few key factors, but the one that moves fastest is utilization. This is the percentage of your available credit you're using at any given time. Most people casually carry 30 to 50% balances and wonder why their score feels stuck. What top-tier borrowers do differently is they treat their credit limits like a resource to protect, not something to max out. If your total credit limit is $10,000, your reported balance should ideally stay under $1,000, and if you want aggressive growth, under $500. The trick most people don't know is that you don't have to wait until the due date to control this. You can pay down your card before the statement even closes, which means the lower balance is what gets reported. That one shift alone can push your score up within 30 days. The second major lever is payment history, and this is where discipline matters more than anything else. One missed payment can drag your score down hard, but consistent on-time payments build momentum quickly. In the US system, lenders report monthly, so every single on-time payment is like casting a vote in your favor. If you've had late payments in the past, the solution isn't to panic, it's to dilute them. Stack 6 straight months of perfect payments and you start to outweigh older negatives. Automation is critical here. Set every account to auto pay for at least the minimum due, because missing a payment due to forgetfulness is just unnecessary damage. Now, here's where most people plateau around 700 and don't understand why they can't break through to 800. It comes down to credit mix and account age. Lenders want to see that you can handle different types of credit responsibly. If all you have is one credit card, your profile looks thin. Adding a second card, or even a small credit builder loan, can strengthen your file, but only if you manage it correctly. At the same time, you don't want to constantly open and close accounts because your average account age matters. The longer your history, the more stable you look. So the move here is controlled expansion, not random applications. Another overlooked factor is hard inquiries. Every time you apply for credit, it leaves a mark, and too many of these in a short window can signal risk. But in 2026, scoring models are a bit smarter. Rate shopping for things like auto loans or mortgages within a short time frame is often grouped as a single inquiry. Still, outside of that, you need to be intentional. Don't apply for 5 cards hoping one sticks. That's how people stay stuck at 650. Instead, space out applications and only go for products you're likely to qualify for based on your current profile. There's also a tactical move that can accelerate your progress faster than anything else, and that's becoming an authorized user on a well-managed account. If someone with a long credit history and low utilization adds you to their card, their positive history can reflect on your report. It's not a shortcut you should rely on forever, but it can give you a strong initial push, especially if your own history is limited. Finally, you need to monitor your reports like a professional. Errors are more common than people assume, and even a small inaccuracy can hold your score back. Reviewing your reports and disputing incorrect information through the bureaus or directly with creditors can remove negative marks that don't belong there. This isn't about gaming the system, it's about making sure the system is actually representing you accurately. If you execute this correctly, keep utilization low, never miss a payment, expand your credit profile strategically, minimize unnecessary inquiries, and clean up your report, you're not just chasing a number. You're building a financial identity that lenders trust. And once you cross into that 750 to 800 range, everything changes. Lower interest rates, better approvals, more leverage. That's when credit stops being a limitation and starts becoming a tool.